Welcome back to Iron Financial, the shop where we forge stronger portfolios by stress testing the market's biggest stories. I'm your lead analyst, and today we are putting Lemonade's Q4 earnings report right on the anvil. They just dropped their numbers, calling it their strongest quarter ever. Now, the market absolutely ate it up, but our job here is to hammer on the details, to cut through the noise, and to see if this company is truly building a financial fortress, or if we're all just looking at a house of cards waiting for the first stiff breeze.
And when I say the market ate it up, I mean it. The initial reaction was just explosive. Right out of the gate, pre-market, the stock surged 13%. Now let's be clear, that is a massive, massive vote of confidence from Wall Street. It tells you that the headline numbers weren't just good, they were the kind of impressive that makes traders slam that buy button before they've even finished their morning coffee. It's a powerful signal that the story Lemonade is selling is resonating, and big money is betting hard on that momentum.
Well, hold on. A 13% pop is fantastic if you're a day trader looking for a quick score, but we're here to build long-term strength. We're forging portfolios that are meant to last. That kind of surge, let's be honest, it can be built on pure hype just as easily as it can be built on a solid foundation. So the real question for us isn't whether the market is excited. The question is why it's excited. We need to get under the hood and inspect the actual structure. Can it support this kind of valuation? Are we looking at a steel fortress in the making, or is this just a really, really fancy facade?
Exactly. And that is our blueprint for today. We are going to inspect this company piece by piece, just like a structural engineer. First, we're going to dive into that growth story, looking at the top-line metrics that are fueling all this excitement. Then, we'll get to the heart of the matter, the profitability puzzle. Can they actually turn all this growth into real profit? After that, we go deep into the engine room to inspect the cash flow. Is this company generating real, hard cash? Then we will analyze their big, audacious bet on the future, AI and autonomous vehicles. And finally, after we've stress-tested every beam and pillar, we will deliver the Iron Financial verdict. Let's get to it.
Okay, Section 1, Forging the Growth Story. This right here is where the entire bull case begins. You just don't get a double-digit stock pop on a weak story. You need some serious firepower on the top line. And let me tell you, Lemonade delivered. We're going to break down the 3 core pillars that are holding up their entire growth narrative right now.
Let's start with the single most important metric for any insurance company, in-force premium, or what we call IFP. Think of this as the lifeblood of the business. It's the total annualized premium from every single active policy they have. It's their book of business. For the fourth quarter, Lemonade's IFP smashed through the $1 billion mark to hit $1.24 billion. And get this, that's a 31% increase from the same time last year. That number tells you the core of their business is expanding at a blistering pace. It's proof they are successfully ripping market share away from the legacy players and scaling up fast. Okay, now this is where it gets really interesting, so pay attention to the gap here. Total revenue was up a staggering 53%. So wait a minute. Their premium base grew 31%, but their revenue grew 53%. What does that gap tell us? It's a huge signal that the underlying economics of the business are improving, and improving rapidly. They're not just selling more policies, they're getting much, much better at turning every dollar of premium into actual revenue for the company. This isn't just empty calorie growth, it's growth that's getting richer and more efficient as they scale.
And of course, you can't have premium growth without customer growth. All that money has to come from somewhere, and it's coming from people. They are now sitting just shy of 3 million total customers. That's a 23% jump from the year before. Let's put that in perspective. In 2025 alone, they added a net of 550,000 new customers. In this brutally competitive insurance market, that is some serious heavy lifting. It proves their marketing engine is firing on all cylinders, and their tech-first product is truly resonating with a new generation of consumers.
And this chart, well, this chart just brilliantly illustrates the most powerful part of the entire bull thesis. This isn't just a one-off, lucky, good quarter. What we are looking at is the 9th consecutive quarter of accelerating in-force premium growth. Just look at that trend line. Each bar is bigger than the last. That's not just growth. That is a flywheel gaining speed and mass with every single rotation. This is the kind of momentum that forces investors to sit up and pay very, very close attention. The bull case here is that this acceleration isn't ending, it's just getting started.
Okay, impressive momentum, I'll give you that. The growth story is strong, no doubt about it, but growth is expensive. Let's be real. Any startup with enough venture capital can burn a pile of cash to buy revenue. The true test of a durable, lasting business is whether it can forge that top-line growth into a profitable enterprise. So now we have to ask the tough question.
What does the bottom line actually look like? Are all those new customers and premiums actually building a profitable company? Or are we just watching a very expensive, very fast-growing money pit? It's time to look at the other side of the ledger.
And this right here, this slide is the entire paradox of lemonade summed up in 2 columns. On the left, you see a number that looks absolutely fantastic. Gross profit shot up 73% to $111 million. That means after paying out all the claims, the money left over is growing even faster than their revenue. That's a huge sign of improving underwriting. But then you look to the right, and the company still posted a net loss of almost $22 million for the quarter. So how? How can a company be so good at generating gross profit, yet still be bleeding red ink on the bottom line? This right here is where the first cracks in the facade might be starting to show.
Say, you're looking at a single snapshot in time, but you're missing the most important part, the trajectory. The structure is getting stronger every single quarter. Yes, a $22 million net loss is not a profit, nobody's arguing that. But a year ago, that exact same loss was $30 million. That's a 28% improvement year over year. Now look at adjusted EBITDA, a metric that strips out some of the accounting noise and gives us a clearer view of core operational profitability. That loss shrank from almost $24 million all the way down to just $4.6 million. That's an incredible 81% improvement. So the story is not where they are, but where they are headed. They are on a clear, deliberate, and rapid path to break even.
A path to break even, maybe, but just look at the fuel they're burning to get there. It's a raging bonfire. Operating expenses jumped 24% to $154 million. And if you look deeper at sales and marketing, what they themselves call growth spend, that's up 48%. They torched over $53 million in a single quarter just to get customers in the door. And they're not hitting the brakes. They're forecasting $225 million in growth spend for this year. That is a massive amount of cash to burn. And while they're spending that heavily, you see other warning signs flashing. The stock has a beta of 3.35, meaning it's over 3 times more volatile than the market. And on top of that, there's been consistent insider selling over the last 3 months. When you're spending this hard, you better be damn sure the engine isn't about to sputter out.
And that's a completely fair point. The cash burn is real, which is precisely why we can't just look at accounting profits or losses. For a business like insurance, the ultimate test of health is cash flow. So now, let's move from the accounting office down to the engine room. Accounting rules can be complex, they can be manipulated, but cash is king. Cash tells you if the core day-to-day operations are self-sustaining or if they're still hooked up to an IV drip of investor capital just to stay afloat. And when you inspect Lemonade's cash engine, you find a very different and a much stronger story.
This number. This is the number that should silence a lot of the bears. $37 million. That is their adjusted free cash flow for the 4th quarter. Positive, not negative. They generated cash. And let me be clear, this was not a fluke. This is now the 3rd consecutive quarter of positive adjusted free cash flow. So while the official GAAP income statement is still showing a loss, the cash flow statement shows a business whose core operations are now generating more cash than they consume. This is a critical, monumental inflection point for any growth company. It means they are no longer just burning through their bank account, they are starting to fund their own growth. And let's put this turnaround in context, because this didn't just happen overnight. This table, showing their cash from operating activities straight from Stockpedia, paints a picture of a long, deliberate, and difficult multi-year journey. Look back at 2021 and 2022. They were burning through $163 million a year just from their operations. It was ugly. But then look at the progression. The burn slows dramatically in 2023, and by 2024, they're basically a break-even, burning only $11 million for the entire year. This shows a management team with a firm grip on the financial levers of the business, executing a plan to shift from heavy investment to operational self-sufficiency. And hey, don't just take my word for it. Management knows this is the key to their story. The CEO, Daniel Schreiber, said it himself on the earnings call. He pointed out that insurance is an unusual business where cash flow positivity often arrives before GAAP profitability. And the logic is actually pretty simple. They collect a full year's premium from you on day 1, so the cash is in their bank account immediately. But under accounting rules, they can only recognize that revenue month by month, so the cash always comes in the door first. But the crucial part of his quote is the follow-up. The one almost inevitably follows the other. He is telling investors point blank that this positive cash flow is not an anomaly. It's a leading indicator of the GAAP profits that are right around the corner.
So the financials show a company that is rapidly scaling, dramatically improving its profitability, and now, critically, generating its own cash. That's the story of the business as it stands today. But the real reason this stock commands such a premium valuation isn't just about the current structure. It's about the skyscraper they're promising to build tomorrow. So let's shift our focus to that future blueprint. we have to examine Lemonade's massive, all-in bet on AI and autonomy. Is this a truly revolutionary edge that will redefine the entire insurance industry, or is it just a speculative dream that may never actually materialize?
And this single quote from their shareholder letter really sums up their entire grand vision. They're not just trying to build a better, cheaper car insurance company for today's world of human drivers. They are explicitly building an insurance company for a world that doesn't fully exist yet, a world where our cars, powered by artificial intelligence, do a significant portion of the driving for us. Their entire goal is to create a pricing model that doesn't just guess at your risk based on old-world proxies like your age or your credit score, but that knows in real time the exact risk profile of every single mile you travel.
They've given this a name, Autonomy-Aware pricing. Here's the simple version of how it works. By integrating directly with the car's computer system, like they're already doing with Tesla, their system can tell at any given moment who's in control. Is it you, the human, or is it the car's AI? It then prices the insurance for that specific mile based on its unique risk. They argue that blunt instruments like credit scores and marital status become completely obsolete when you can measure the risk of the driving itself second by second. It is a fundamental shift from pricing the driver to pricing the drive.
And this is not just some theoretical concept on a whiteboard. They are already putting this into practice. Right now, as we speak, they are pricing miles driven with Tesla's full self-driving system at about 50% of the cost of an equivalent human-driven mile. Just stop and think about the power of that. If half your commute is handled by the AI, your insurance bill ought to drop dramatically. This creates a powerful, almost irresistible incentive for any customer with an autonomous, capable vehicle to switch to Lemonade. It's a potential customer acquisition weapon that legacy insurers with their rigid, ancient pricing models simply cannot match.
Okay, it sounds revolutionary. It sounds brilliant in a shareholder letter. I will absolutely give them that. But let's get our feet back on the ground here. How in the world do you scale this? Every single state has its own insurance commissioner, its own set of Byzantine, archaic regulations. Getting a simple rate change approved can take months, sometimes years. And you're telling me you're going to get 50 different state regulators to approve a dynamic, real-time pricing model based on an AI they barely understand? And what happens when the AI messes up and causes an accident? Who's at fault? This sounds less like a revolutionary edge and more like a decade-long legal and regulatory nightmare just waiting to happen. It's a fantastic vision, but the path from vision to a profitable nationwide product is absolutely full of potholes.
And that is the central risk. That is the billion-dollar question, and you're absolutely right to highlight it. Which brings us to our final section, the iron financial verdict. We've examined the growth story, we've debated the profitability puzzle, we've inspected the cash engine room, and we've pressure-tested the future vision. It is now time to weigh the steel frame they're building against the potential cracks in the foundation and deliver our final judgment.
Okay, let's lay it all out on the table. On the left side, you have the steel frame, the core strengths of this company. And the evidence here is frankly undeniable. You have accelerating top-line growth in both premiums and revenue. You have profitability metrics that are improving at a dramatic rate. The business is now generating positive and growing free cash flow, which is a huge milestone. And they're sitting on a rock-solid balance sheet with over $1 billion in cash, giving them a long runway. All of this points to a clear, stated path to adjusted EBITDA profitability by the end of this year. And of course, you have that potentially game-changing AI strategy. But, as I've been saying all along, there are also some very serious potential cracks in this structure. They are still losing a significant amount of money on a GAAP basis. The cash they are burning through on marketing to achieve that growth is immense. Their entire long-term bull case hinges on unproven future technology and somehow navigating a minefield of regulatory hurdles. And you just can't ignore the sky-high stock volatility and the fact that insiders have been consistently selling shares.
So what is our final verdict? Is Lemonade a fortress or a house of cards? The truth is, it's both. Lemonade is not a safe investment. This is not a blue-chip stock you buy for your grandmother. It is a high-stakes, high-conviction bet on the future of an entire industry. What we see is a company building a very real, very strong steel framework. That's the accelerating growth, the improving margins, the positive cash flow. Those things are real, they are tangible, and they are impressive. But that entire framework is being built upon a highly speculative foundation. The bet that AI-driven, autonomy-aware insurance is not just a future, but a future that Lemonade can actually own and dominate. If that foundation proves to be solid, this structure could become an impenetrable fortress. But if it cracks under regulatory pressure or technological failure, the whole thing could come down. It is the definition of a high-risk, high-reward play, and any investor needs to understand exactly which part of this structure they're betting on: the steel that's already in place or the speculative ground it's being built on.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.